On a crisp September morning in 2008, 25,000 professionals woke up to find their jobs, their pensions, and their entire firm vanished. Lehman Brothers, a 158-year-old financial titan, ceased to exist in a single day. Lehman held over $600 billion in assets on the day they filed for bankruptcy, yet they lacked the cash required to pay the bills coming due that morning. This is the difference between solvency and liquidity. Owning a portfolio worth billions on paper is meaningless if you have zero access to cash for immediate daily obligations. Since the housing crash, Wall Street has promoted a narrative of a fully insulated system. We are taught that new banking regulations permanently patched the systemic flaws of 2008. However, the specific mechanics that killed Lehman, their extreme leverage, hidden toxic assets, and sudden illiquidity, remain active in the financial system. They had migrated out of the Tier 1 global banks and into regional banking, commercial real estate, and retail brokerage apps. The collapse of Lehman Brothers exposes the same risks currently circulating through the markets of 2025 and 2026. Lehman operated on a 30-to-1 margin. For every dollar of actual cash in their vault, they borrowed and bet $30 in the market. This math meant a tiny 5% dip wiped out a capital base. Today, this risk profile exists inside modern retail portfolios. Utilizing margin creates an identical vulnerability. Borrowing $2 for every one you actually own means a 50% market correction results in total liquidation. Retail brokers aggressively encourage this margin usage, wrapping massive debt obligations in a gamified, accessible interface for everyday investors. Systemic leverage has migrated from the core of the banking sector and into the hands of the individual American investor. When Lehman's mortgage assets began losing value, the firm used an accounting maneuver called Repo 105 to temporarily shuffle billions of dollars in bad debts off their balance sheets. This allowed them to project health to investors while the foundation of the firm was rotting. A similar pressure is mounting today across the regional banking sector. Between 2024 and 2026, a massive $2 trillion in commercial real estate debt is reaching maturity, with regional banks carrying the vast majority of the exposure. High vacancy rates in commercial offices have depressed property values. Banks rely on an extend and pretend strategy, modifying loan terms to delay defaults and keep toxic portfolios looking stable on quarterly reports. Accounting tricks create a temporary illusion of safety, but this paper stability shatters when loans come due, and owners are forced to face current market valuations. By September 2008, banks stopped lending to Lehman overnight. Market crashes froze the commercial paper market, the short-term funding banks used to operate, triggering a run that drained billions in cash and jammed the gears of the entire financial system. This sudden liquidity freeze reappeared in March 2023, during the collapse of Silicon Valley Bank. SVB classified its bonds as hold to maturity, recording them at their original purchase price. However, rapid Federal Reserve rate hikes lowered the mark-to-market value, the price those bonds would fetch in an immediate sale. When depositors pulled $42 billion in a single day, the bank was forced to sell those bonds at a $1.8 billion loss, wiping out their capital. Both crashes demonstrate that having assets on paper is meaningless if they cannot be converted to cash during a crisis. Market crashes are a mechanical certainty of the financial cycle. When the system breaks, individual retirement accounts face the full brunt of forced liquidations and market volatility without the institutional backstops provided to global banks. Surviving a liquidation event requires defensive positioning. Rule 1 is removing margin from your accounts. Trading only with settled cash prevents a broker from being able to force the sale of your shares during a sudden market dip. Rule 2 is diversifying into uncorrelated assets. Protecting a portfolio requires holding assets that do not move in tandem with major tech or stock indices, ensuring a safety net if a specific sector bubble pops. Rule 3 is maintaining liquidity. Holding a portion of your portfolio in cash or short-term treasury bonds ensures you have the necessary capital to cover obligations or wait out a market freeze. This liquidity also provides an offensive advantage. When leveraged investors are forced to sell their holdings to cover debt, liquid investors can acquire high-quality assets at deep discounts. Building wealth that lasts for generations requires data, preparation, and discipline to move against the crowd. For more financial analysis, hit the subscribe button and join us as we break down the data behind the markets.